This is our Forex blog for April 4th, 2012, and this is our currency meter. It's one of the easiest ways for new traders and advanced traders to trade. We statistically compare every currency to every other one, and we use on the top the histograms made up of 5 of our best statistical tools we've developed over the last 6 years. 3 of them measure the direction, in this case that the dollar's moving versus all the rest, and 2 of them measure the intensity. So anytime you have green at and above the dotted 80 level, it means the vast majority of dollar pairs are going up, and they're also going up with a lot of intensity. Basically, it's very easy to trade when you have a pretty much clear-cut trend all the way across. Underneath that, we have the daily trend, weekly trend, and monthly trend. I primarily focus on real-time trend, and if it matches the daily and weekly trend, I'm more apt to take those trades. And you basically want to buy the strongest currencies versus the weakest. The dollar and the yen, both strong. The euro's very weak. The Swiss is weak. The Australian is very weak. It had about a 3-hour counter trend move here. But anytime you have a currency that's this weak, usually it's pretty safe to assume, and today it's definitely what happened, that longer term trend is going to resume. And after about an hour of strength here, you have about an hour of weakness, a couple hours of strength, and then weakness again. And that's how you use the currency meter. Let's take a look at selling the euro versus the dollar and the yen. 2 common sense, no-brainer type trades today. So here is the euro dollar. Let's look at it coming into today. The only downside of this particular chart is that it's underneath our 2.0 white containment band. Very strong trends can continue, but when they're underneath the containment band by, let's just say, 15 to 25 pips, you're more apt to get reversals. So I would personally have waited and maybe not taken this initial trade last night, but when it pulls back up close to, and it can be even 5 and 10 pips underneath the white band, but I don't like to sell it 20 or 30 pips underneath there. As soon as it starts going back down, you get short, and you can use our trailing stop to get out. You didn't make them that much on the first trade. You're short again here, and you can see it fell another 30 pips. Let me show our range chart, and this is why so many people love our range chart, is you can go short and use the trailing stop to get you in and out. So this trade right here, let's start with the one that I would have taken at 3:30. Short at 89. That trade didn't pan out. You would have maybe lost 2 pips. Short again, let's stay at 85. Out at 73, made 12 pips. Short here at 66, out at 52. And usually when it gets down underneath the 3.0 green band, you're going to get a reversal. So you can take one more trade, but you usually want to draw your fibs. And when it gets down to that fib area, you want to really stop selling. Usually currencies will make 3 waves in one day. So it's going sideways. This is your first. Actually, last night was your first wave. First wave, sideways, second wave, and then this is the third wave. But once it has a nice reset here, it kind of went up about 40 pips. You could have shorted this as well at 35 and out at 22. So that's only a 13 pip movement. A lot of traders might think, I'm not going to even waste my time on 13 pips. But the point is, 10 pips per day can double your account every 2 months. Here's a $2,000 account, 10 pips per day. Start off trading 4 mini lots. That's $4 a pip. And in 8 weeks, pretty much 2 months, it's come close to doubling. And 2 more months, it has doubled. Obviously, we're incrementing this by 0.1 lots at a time. If you did it with fractional lots, it would be a more smooth doubling. But nonetheless, the 18,000 is now about 18. And you can see the effect of compounding. It's 258,000 after just 1 year. But you're trading 51.7 full lots. That's a lot of lots to trade, and most of the time I don't even myself go over 30 lots at a time. Some trades are as low as 5 lots, and I'll do 10 lots, and sometimes scale into 30, 35 lots. But 50 lots is a lot of position size to trade. But the point is, 10 pips per day, especially with a smaller account, can double your account every 2 months. So if you're one of those traders that thinks that 10 pips or 15 pips is nothing, it's not something you'd even want to take a trade for, keep in mind that 10 pips a day doubles your account every 2 months. And anyone who thinks that performance is not worth trading for, in my opinion, is a total idiot. So they're more likely to lose all their money, and they're not going to be around. If you think that way, you probably should give your money to more intelligent people to trade for you. But anyway, you can see 36 out at 23. And some of your trades are going to be bigger. You have this nice little sideways range right here, short here at 66. If you waited for the fib target to get out, you made about 40 pips on that trade. It's pretty much an entire week's worth of profit. And let's look at some of the other trades. Week Swiss. Oh, actually, we want to trade the euro against the yen too, so we're going to look at the euro yen as well. This one is a little higher probability trade because it wasn't already underneath the lower white band. This is one of our sideways rectangle patterns. Anytime you have a very strong trend in one direction and it goes sideways, I would say for at the minimum 2 hours, and 3 to 5 hours is even better. The longer it goes sideways without going up, the more likely when it is to break down, whoever's buying it here and holding it from going lower, and it was right near the whole number and right near a weekly S1 pivot number, and that's probably the two reasons why there were buying right there. Once it broke that level, and especially once it broke yesterday's low, it was off to the races. And notice our trailing stop kept you in this trade all the way down to here at 34. You're short at 93 for a nice 60 pip move. Again, that's an entire week's worth of profit plus 1 day. And when it's this far underneath the band, I personally myself would have avoided this trade. But if you want to use our range charts, you're risking basically 6 pips plus a pip or 2 padding if you put your stop just a pip or 2 above the high. So if you do short here at 36, you're risking 10 pips. With this kind of a volatility, this kind of extreme weakness, all the time frames are down. It's not a bad trade. 35 out at 17 for another 17 or 18 pip win. Let's look at some of the other ones. Extreme Swiss weakness. And so that means you want to buy the dollar Swiss today. And this had the exact same pattern. This one, unfortunately, is above the upper band. But anytime it's above the upper band, it kind of went sideways for at least 3 or 4 hours, you really can take a trade on there. It doesn't mean that the first trade's going to work, but typically if you keep trying to buy it when it breaks out, you're going to make your money. So if you bought this breakout right here, you can see you lost 10 pips. You bought it again, you pretty much broke even. Kind of went sideways again, broke out, you made a little bit. If you bought this breakout here at 58, you're out at 69, you made 10 pips. And most of the time when they were kind of chopping around like this, if you draw your fibs on that last wave up and kind of just what I always do, and currencies tend to be a little choppier, put my stop underneath the swing lows, and every time it makes a higher high and kind of goes sideways, I move my stop up. Kind of goes sideways here, move my stop up. And then you're looking to get out at one of these fib targets. I would have got out first half of my trade here, in the second half at the 1.618. Anytime you see the 1.618 fib target and it's above our 2.0 white band, there's about an 80% chance that that's the maximum profit you're going to make. And when it lines up with one of my overnight Fibonacci areas, I do the analysis every night for my own trading, and it shows up on your charts as well. These are Fibonacci profit target levels that I think are going to be major resistance. The first one, you can see it was. The second one was the high of the day. If your intraday fib lines up with one of my overnight fibs, which are usually based on multiple day and sometimes week moves, 1 week, volatility moves, these are very likely to be the maximum high of the day, especially when it's above the upper band. So you might want to exit your trade up here at 79 versus letting the stop get hit. That makes you an extra 10 pips or so. The pound also quite strong on all time frames. Obviously it had some weakness here for an hour, 15 minutes, 40 minutes, 15 minutes. But if you traded that pound against the week euro, the week Swiss, and the Australian, which I'll show the Australian now against the dollar. I think I might have already shown it, but I will do it again. You can see it's underneath the lower band. You get short right here, you pretty much broke even. Short right here, very small profit. And notice my Fibonacci profit target level was the low as well. Let me just show the 6 pips per bar chart on the Australian dollar, and this is why I personally like to trade it. When you're down this much and you get a nice move up, especially to the hourly moving average, it's a pretty decent place to go short. You really didn't make that much in the first trade. Second trade here at 69, out of 62, not the biggest profit in the world there either. But you rarely lose money when you're shorting an extremely weak one. using range charts. You're in, out, pretty much break even, in, small profit. You know, this one just had already fallen the previous day so much that there really wasn't that much more intense selling today. And that's why it's always best to bring up another chart just to kind of let you see what the daily and hourly and or 4-hour chart looks like. So if you bring up the Australian dollar, you know, I'm not looking at one chart when I trade. I typically will look at the daily charts, which I hide on a different layer before I even start trading, just to see which currencies have been up or down 3 or 4 days in a row, or which currencies have already made like a 200 or 300 or 400 pip move without any kind of a decent pullback. And I would call a decent pullback 38% retracement. So I'm going to put a point D on here, which lets you see the daily chart. And you can see that this one's kind of been trending down. And yesterday was a big trend day down. And today it broke the lows. So certainly underneath 1.0300 is a decent place to look for sells. But we're also coming up to the fib target of this first wave down right here. You can see it went right there. So underneath 300 it's okay to sell, but 1.0254 is likely to be major support. So by looking at a longer term chart, here is the 1.0254 area. This is an area where it's not likely to go too much below. So if you wait for a little bit of a pullback here, and a lot of times when I get a pullback up, I will kind of sell the lows right here with my stop right above the high. And as it's coming down, I'm watching. On the move up there, it had a lot of intensity, and then has a little bit of weakness right here. And as it's going sideways right there, there's not that much strength. So it's very likely to continue down, but I'm going to move my stop down here. And just to be safe, I always get out of half my trade when it hits my first fib target. So I would have been out of the first half here at 59. I'm short here around 84. So about 22 pip profit. And I probably would have got out of the second half right here. So not the biggest trade in the world. However, you know, when you keep yanking your stop down and you exit half at the fib targets, when you know right here at 60 or 59, it's not likely to go more than another 5 pips your way. When you have a longer term perspective, you can take trades that you might not, you know, otherwise take. And you also will tend to exit optimally at very key support or resistance areas. Let's just end today's class by bringing up the euro pound. Weak euro, strong pound. You're going to have this go down, 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 and you can see that's exactly what it did. It broke the previous day's low last night, and then it trended down all day. And that's the whole purpose of our currency meter, so that you can find strong currencies like that. The pound Australian is very likely to have gone up most of the day, which it did. If you were basically focusing on buying this, you might have bought this pullback here, made 10 or 15 pips, bought this pullback here, made a little bit, bought this pullback here. You always want to draw your fibs off of any decent sized move. When it gets to that fib target, don't be greedy. So you might have a small win if you had bought this breakout back above the previous day's high here at 51. It went all the way up to 88 or so here. So that's a 35 pip win. But if you focus on buying this on every pullback, you know, it kept pushing up, because the pound was so strong, and the Australian is weak on all time frames. Obviously, an hour of strength can come in the Australian, and maybe an hour and a half or 2 hours. But when you have a currency that's this weak on the longer term trend, you really can't go wrong by trading the strong ones versus the weak ones.